Good afternoon and welcome to another Impact Lender webinar. I'm delighted to have with me today Simon Wilson, who is Key Account Manager of Bluestone. In a second, I'll pass over to Simon, who will go through what Bluestone can do. In the meantime, please do use the chat function to ask any questions. I've got a few questions that I will ask Simon towards the end. And at the moment, Bluestone are in our top 3 lenders within the Impact entity. On the packaging side, we've got a very good relationship with them, especially with regards to some exclusive products through their Sapphire range, and I'm sure Simon will go through that in a second. But like I said, if you could send us any questions that you have as Simon goes through his presentation, I may well butt in at some point and ask the questions, or we'll wait to the end and then quiz Simon towards the end. So Simon, if you want to start sharing your screen, and I will hand over to you. I'll take a back seat and I will speak to you in a bit.
Good afternoon, everybody. My name's Simon Wilson, and I'm the Key Account Manager for Bluestone Mortgages. Thank you very much for taking the time to watch today. And please, if you have any questions at the end, I'll be more than happy to answer. But let's start off the presentation. So first of all, let's talk about the elephant in the room. COVID-19 has impacted on all of us in one way or another. And 2 out of 5 applicants have confirmed that COVID-19 has limited their choice in lenders. However, Bluestone Mortgages are very proud to say that after lockdown, we were one of the very first specialist lenders to come back to market, and also with our full criteria range on credit, which was very limited in the market as a whole. But we are glad to say that we have come back, and we come back strong, and only reduced our LTVs 75%, which seems to be somewhat the standard, and we're looking to increase that in the future. But all in all, we are definitely in a strong position to work with you guys in Impact. So moving on. Are credit scores important? So most people think so, with around about 80% of customers thinking that their credit score is important in getting a mortgage. Now, in seeing those stats, you would think that people's credit files are on the up and you wouldn't necessarily see so many issues with people's credit files. However, moving on to the next slide, you will see that CCJs over the past 5 years have actually, in fact, increased in the number of CCJs that have been registered in the past 5 years. However, the value of those CCJs are slowly decreasing, making it a lot easier for people to find the right lender who will lend to them in the right situation. So although people are aware of their credit files, we still see a lot of people with credit issues where they may have CCJs. So if you are struggling to understand credit files and you want some support with that, on our website, we do have we've recently put on there our own guide to reading credit reports, which we've had great feedback on. If you want to have a look in your own spare time, please do. But let's move on to see how we can help your customers. So first of all, credit scoring, as I said before, we don't actually do any credit scoring at all. It's a soft footprint search, a decision in principle, and we only actually register the hard footprint once we've agreed the application for the client. So if we don't actually proceed with the application, we don't have any impact on their credit file at all with any searches. Dale mentioned earlier, we have our Sapphire panel, which Impact are a very big and important part of that. And one of the elements of criteria that we do offer to Impact as a semi-exclusive is IVAs and bankruptcies. So the standard criteria for IVAs and bankruptcies is that they have to be discharged for 3 or more years. However, with Impact, we will allow an IVA to be cleared upon completion and bankruptcies to be discharged 1 year ago, which is currently market leading criteria. So if you do have somebody with an IVA or bankruptcy, please do give Impact a call to run through the options on products and rates and so on and so forth with us. DMPs are completely accepted with us. They can remain in place after completion. They can also, we take the current commitment instead of looking at the original balances that some other lenders may or may not do. But DMPs are not a problem for us. We just need to demonstrate that they've been well maintained for the past 12 months. However, they don't need to be running for a minimum period of time. An applicant could have entered into a DMP a month ago, let's say, and as long as they paid it for that month, then we're happy to proceed with the application. We also allow up to 4 defaults per applicant. So we have no monetary limitation, although, as I said before, CCJs are reducing in value. We don't actually have any limitation on CCJs or defaults with regards to the value that they are. So we'll do a total of 4 registered defaults within the last 3 years and 3 CCJs per applicant. And we also allow up to 4 applicants. So I've never come across somebody maxing out on all of those, but it would be very interesting to see. However, there is a lot of scope for defaults and CCJs with us. We disregard anything under £300 in value, and any communication suppliers are also disregarded as well. Mortgage arrears. So unfortunately, we don't allow any mortgage arrears within months 0 to 12. However, we do allow 4 within months 13 to 24. The way that we're different to other lenders in this situation is that we consider what we consider as a late payment. So it's not necessarily the arrears that we're talking about here. It's when they actually miss the payment. So I'll give a worst case scenario example. Say for the past year, the applicant has been up to 4 months in arrears in their mortgage. That is not a problem for us. As long as those payments went from a 1, 2 to a 3 and a 4, more than 12 months ago, we are happy to consider applications on that basis. So it's actually when the missed payments occurred, not how long they've been carrying the arrears, because for a scenario like that, for the past year, although they're 4 months in arrears, they have been paying their mortgage on time for the past 12 months. We also can consider situations where an individual has paid their mortgage payment late. That is not necessarily a missed payment to us. What I mean by that is if somebody had, say, for example, in the past 12 months even, has got a 1 down on their credit file on their mortgage, that can mean that potentially they made that payment up to 30 days late. Now, if that is the case and it's still shown as a 1 down on the credit file, and we can be provided with evidence that it was paid within 30 days that the payment was due, we will disregard that missed mortgage payment. And for somebody in a situation that they may have even paid their mortgage late last month, we could still disregard that if we have the evidence. So very flexible with regards to our credit criteria. And as I said before, all of this is exactly the same as it was pre-lockdown, and the flexibility and how we work is still exactly the same. So when it comes to missed payments on unsecured credit, we allow up to 2 missed payments in the last 6 months on unsecured credit. Now, I'm going to explain how we view credit as a whole and how we apply our criteria, because it is slightly different to other lenders. So first of all, we apply the criteria to the date of completion and not application. So for example, if the case doesn't fit today, but it will do in 3 months' time, because we have a 3-month window to apply this scenario, we will add a condition to the offer to say that we can't complete until it does fit criteria. So for example, we don't allow any defaults registered within the last 6 months. If you've got one that's registered 3 months ago, we will condition the offer to say we won't complete until it's 6 months old. Therefore, moving the process forward a lot more than what other lenders can do, getting an offer out for you and getting everybody in the chain happy and putting less pressure on the client as a whole. So let's move on to our self-employed solution that we can offer. First of all, we allow 1 year's trading as a bare minimum. Now, the interesting part about this, because quite a few lenders do 1 year trading on self-employed, is how we evidence that 1 year's trading. So first of all, if you have got somebody who has been trading self-employed for less than 2 years, we will only ask for an accountant's reference to be confirmed, to confirm that income, sorry. Now, the reason for that is when somebody only has 12 months trading and they've done their tax returns or the accounts have been produced, a lot of the time they've been produced partway through that first year. Therefore, you don't have a full 12 months of figures. That means that when we ask for the accountant's reference, we ask the accountant to confirm the full 12 months figures, therefore maximizing the affordability for somebody who only has 1 year's trading. We also use, if somebody has more than a year, so 2 years or more trading, we also do allow them to use the latest year's figures. Now, the figures that we use in that situation are, if it's 100% shareholder of a limited company, we can use net profit after taxation plus the salary, or the dividends and salary, whichever is higher. A lot of lenders can get uncomfortable with large jumps from year 1 to year 2, whatever it may be, if we are using the latest year's figures. I personally haven't come across a case where we haven't been able to look at the accounts or get an explanation from the customer and understand why the figures have increased so much to the latest year. So every single time I get an application like that, I'm extremely confident that we will use the latest year's figures. We also do capital raising for any purpose. Now, the common questions I get asked in this situation is things like, capital raising, any limitations? Nope, none at all. As long as we're within our LTV limitations, which is currently 75%, we're fine to do capital raising for debt consolidation up to any amount. We also do for business purposes, which has to be looked into in a little bit more detail, as you can imagine. Startups aren't really what we can do because it's a little bit too risky. However, if it's an established business and the business isn't failing, we're not bailing them out, we're happy to do for business purposes. We can also do capital raising for tax purposes, which is quite hard to place, I understand. And in situations like that, we just need to evidence that the situation causing that tax bill has now been resolved, and it's not going to be a year-on-year reoccurring situation. So a large amount of the UK public, 4.8 million of self-employed workers, represent 15% of the workforce, which is a huge amount of opportunity for brokers to do a lot more business for customers who may not fit the high street for those self-employed situations. But overall, we are extremely flexible when it comes to self-employed customers. Moving me very nicely onto our other type of self-employed customer, who may be a contractor. So our contracting criteria, although we are predominantly a specialist adverse lender, our contracting criteria is actually out there with one of the best in the market, in my opinion. So first of all, if you have an individual who is a self-employed day rate contractor, we will accept their day one contract. So if they started with a new company today and it's their first ever day rate contract, we will use a 48-week calculation to calculate that day rate contract, and we'll be happy to lend. We just need to ensure that there is 3 months remaining on the contract at the time of offer. Now, I understand that a lot of times at application, there may not necessarily be 3 months remaining on the contract, because a lot of day rate contractors work on the basis of monthly renewals, 6 monthly renewals, whatever it may be. However, if they don't have 3 months remaining on the contract at the time of that we're offering the case, we are happy to receive a letter from HR, management, whoever it may be, confirming they anticipate the contract to be renewed. We're very flexible in those situations to understand if somebody is going to get renewed, and it usually comes down to how busy that individual has been while working that latest contract. Alternatively, if somebody doesn't have that amount or can't get that sort of reassurance of a renewal of contract and having 3 months remaining on it, we will actually allow somebody, if they have experience already in contracting of 12 months or more, they don't necessarily need to have that 3 months remaining because they've got that experience in place. We also allow gaps as well in contracting up to 6 months. And also, if it is put through a limited company, we are still happy to use that day rate and that 48-week calculation. So contractors as a whole, on a self-employed basis, are very flexible. We also do allow applicants who are fixed-term PAYE contractors. That requires a 12-month experience. And also, we do allow 0-hour and temp contractors. However, that requires a very long period of experience, which is 2 years, predominantly because it's hard to show track record in those sort of situations. Okay, affordability. So I'm going to cover off one point that's actually not on this slide, and it's probably very important for you to gauge how much we can lend on affordability, which is what is our maximum multiple. A lot of lenders don't like to talk about it. But we're quite happy to do so. At the moment, it's 4.5 times income. So pre-lockdown, it was 5 times, and we're currently reducing down to 4.5. However, we will be looking to increase back up in the future potentially. But at the moment, it is 4.5 times income. But ultimately, it always comes down to the main thing of monthly affordability, which is something that Impact actually are very good at getting right first time to ensure that we don't get any reductions in loan amounts when it comes to getting to underwrite stage. The affordability and DIP assessment that Impact carry out on your behalf is cracking. We have a good success rate of keeping those loans where the clients want them to be. So let's talk about some other points. So the minimum age for applicants is 20 years old. The maximum age at the end of the term. This is a flexible area of criteria which we work with on a case-by-case basis. However, if you want to work by a rule of thumb, we work by manual workers will lend to the age of 70, non-manual workers 75. However, we do regular exceptions on this situation. We go to the ages of 80, and I've seen a case go to 85 before. Depending on the type of income, depending on the type of company setup that maybe someone has as a self-employed individual, maybe they're sitting back collecting dividends and they've got a management structure below them, which means that their day-to-day work actually isn't too much. Therefore, we're likely to understand that company up front for you and make sure that we can stretch the term as long as possible. So we always try to keep that in mind as well. We allow up to 4 applicants, as I said before, but we use all 4 incomes if they are available. So if even to the extent if an applicant has multiple jobs, as long as they've been within those second and third jobs for more than 6 months, we're happy to include those as well. But having 4 applicants and all 4 incomes could massively help a situation. We have also had situations where if individuals are not fitting criteria, but they want to go on the application and they're not fitting criteria, say for example somebody who doesn't have permanent rights to reside, we will allow them to go on the application to get on the mortgage ladder as long as their income is not included within the application. So just a small workaround to ensure that somebody can get on the application and on the property ladder if they need to, but as long as the affordability works. The 4th point there is married in sole name. So this is an interesting one. So standard criteria is actually if an applicant is married, we require them to both be on the application. However, we do have workarounds to this. So the first one is that if it's a remortgage and it's currently in one applicant's name and they're married, that's fine. They don't necessarily have to put their partner on there. The second one is if we're looking at a purchase and the monies are coming all from one individual for the deposit, and we also get the applicant who isn't, sorry, the person who is not going to be on the application to get independent legal advice. We basically take a sensible view at underwriting in those situations that not all married people want to share all the finances, which is fine by us, as long as we understand the situation up front. We also do fee-free remortgages, so up to 75%, which includes also standard legal work. You can also have debt consolidation, which is included within that standard legal work these days. We also do a free valuation, and we don't have any application fees. It is purely an arrangement fee that can be added to the loan if it's all affordable. So good options when it comes to fees-free remortgages with us now. Now, the other area that Impact have within their Sapphire semi-exclusives is our Help to Buy range, which at the moment is extremely popular. So we allow a free valuation on all of our Help to Buy applications. It's obviously been extended. We allow up to 5% builders incentives, which is pretty standard, and they're available on our A to BBB categories. It says here target audiences, adverse applicants. Now, the adverse that I went through, the adverse criteria, sorry, that I went through at the beginning of the presentation, that all still applies to Help to Buy applications, even with the 4 defaults and 3 CCJs, the IVAs, the IVA exclusive criteria that Impact get, that can all still be applied to a Help to Buy application, so an individual with a 5% deposit. So it's a very, very strong proposition. If you want to keep up to date with us, please do so, actually. And I ask if you can follow us on LinkedIn, Twitter, or anything like that. That would be very much appreciated. We as a lender are ever evolving, we're growing, we're hiring more people in these busy times because with limited lenders out there, we are very much looking to push on and do as much as we can for clients. We're currently hiring, for example, 4 new underwriters to expand our team and to try and keep on delivering a good service as much as we possibly can. So my point in saying that is that we are ever changing, and to keep up to date with what we're doing, please do follow us on LinkedIn, because we are constantly updating what we're doing. And I guess it's now time for questions and any feedback. I'll stop sharing and pass you over back to Dale.
Brilliant, thanks, Simon. That was really informative. Like that a lot. A couple of bits I've taken from there as well. So, a few questions first of all. Obviously, the market has taken a hit with regards to mortgage payment holidays, bounce back loans, all that sort of stuff. How do you deal with clients who might have taken those previously when they come to apply for a mortgage with Bluestone?
It's a very good question. So with regards to the payment holidays, we have no problem with them at all. As the government stated, we cannot be discriminating against any client who took a payment holiday for COVID purposes. Not a problem at all. The best part of your question is the bounce back loans and any sort of loans that businesses may have got over the period of lockdown or afterwards. We are 100% fine with them. So there's a lot of situations where individuals took the bounce back loans because the company was struggling. If that's the case, then that's fine. We just need to demonstrate a 2-month recovery period after that. So post lockdown, has the business got back to where it needed to be after needing to take that bounce back loan? I've also been asked by quite a few people, what about the businesses who took the bounce back loan but didn't necessarily need it? Will that be viewed negatively? Not at all, not at all by us. So it's not a problem at all that individuals have taken those or companies have taken those loans.
Yeah, I think it's taking available funding while you can, because
exactly.
when you need it, you can almost guarantee it won't be available.
Exactly.
Adverse market, do you think this part of the sector is going to really grow over the next 6 months, especially with obviously what we're going through and what we're about to go through again with the lockdown period and so on?
Yes, very much so. Our opinion as a whole, and Bluestone as a whole, is that we think it will create a significant uptick in the specialist adverse market for sure. We expect to see things getting much busier from our point of view, hence the hiring that we're doing and the growing as a business, even in times like this. It's and I think it's definitely most important that the mortgage market adapts to that to be able to help support those additional customers and you know, lenders as a whole, not just Bluestone Mortgages. I think it's down to everybody to adapt to the times and make sure that we are here for every type of applicant to be able to support them. But yeah, we definitely think that there's going to be an uptick in that area.
Yeah, I think so as well. And obviously we're going to a lockdown period, but at the moment the valuers can still go out to properties. What are you going to do if the valuers get locked down as well and can't go out to properties?
Okay, so yeah, actually, just before the end of last year, we started working on our AVM a deal with Connells. So although Connells actually did formally come back to us and say, I think it was 2 days ago, that they were told by the government they're 100% okay to carry on their jobs as per usual. However, if they were to get into a lockdown situation and weren't allowed into properties, we are more than confident we can support that still with AVM and desktops via Connells as well. I think they're expanding as well with regards to that area and getting more people on panel and training up and things like that. So as I said before, lenders need to adapt, you know, valuers need to adapt as well. But we are definitely in a position to be able to handle it because we now have our AVM systems all set up.
Yeah, of course. And are you missing seeing people face to face as a key account manager?
Very much so. I'm getting cabin fever. And although it's great spending time with my girlfriend and us sitting next to each other and arguing who's the loudest on the phone, it's I do miss things like this, actually seeing people and interacting. It's the best part of my job, going out on the road and speaking to people face to face. And I'll be honest, I do miss it a lot. But things like this help massively. It really does, especially for things like just generally things like mental health, you know, keeping your spirits high and actually talking to people.
Yeah, absolutely. Well, look, we're running out of time. Simon, really appreciate you giving us your time to give us a presentation and go through all the pros and bits to deal with, or why to deal with Bluestone. So appreciate that. Thank you.
No worries.
And we have a really good relationship with Bluestone. So please, any queries, any questions as a result of this, any inquiries you want to discuss, give the team at Impact a call. Like Simon said, we have exclusives or semi-exclusives to some of the products against the normal standard ranges. So very worthwhile getting in touch with us. In the meantime, we'll do some other webinars shortly. We've also just done an interview with Robert Sinclair, the Chief Executive of the Association of Mortgage Intermediaries. That is live on our website now, so please do go and have a look at that. But I thank you for your time today and hope you found it useful. Keep well. We'll speak to you soon. Many thanks.